US equities have benefited from the improved risk sentiment due to a combination of factors. One, the Fed has signaled that it is unlikely to raise rates anytime soon. Two, recent US economic data has been encouraging. And three, increasing optimism around the potential conclusion of a Phase 1 agreement with China. However, US equity valuations are not cheap at current levels, which makes us cautious of the potential for pullbacks. Furthermore, the spotlight could soon shift back to the 2020 US elections and associated risks such as the greater scrutiny of large tech companies. These uncertainties are likely to remain a source of volatility going into 2020. Now, here in Asia, we expect investors to refocus their attention on underlying fundamentals as trade concerns ease, and we maintain our advice to use the tactical window to rotate towards better quality holdings in property, infrastructure, healthcare, consumer staples, and discretionary sectors. In China, we expect policy will remain accommodative with an easing bias but no massive stimulus. The Chinese equity markets is trading at close to the high end of its relatively tight valuation multiple range over the last 6 months. We prefer the internet, consumer-related sectors, and selected companies that would benefit from the structural growth ahead and also offer stable dividends. Over in Europe, as we move into 2020, equities look likely to remain supported by the improved risk-reward profile of the diminished risk of a no-deal Brexit, undemanding valuations relative to the US, and also light investor positioning. There is also the potential for more easing under new ECB President Christine Lagarde and more fiscal stimulus from Germany, although this might be some time away. Finally, in Japanese equities, a moderate growth outlook as we enter 2020 leads us to be highly selective. We maintain our bottom-up stock-picking approach, favoring companies with relatively more resilient earning and growth prospects.